I've been trading over 16 years, and in this video I show you my 7 top trading tools, signals and indicators that I use every single day. We're starting with the daily high-low indicator. Technically you don't need an indicator to plot the daily high-low, but I think it comes in handy. In TradingView, when you search for the daily high-low, this is the one that I'm using. What it does is that it creates a channel around your price action, plotting the previous daily high and low. This is really interesting, especially for day traders and short-term traders, because the daily high-low is a reference point used by many traders. You can use it for trend following trading, but also for pullback and reversal trading. I made a few videos on my YouTube channel about this. In a bearish trending market, what you will often see is that the market keeps pushing into new daily lows and so advancing the trade to the downside. When the market is failing to reach the daily low and then reverses into the daily highs, a new uptrend is often started. Following the daily highs and lows and the exhaustion and rejections around the daily high-low patterns and the levels is really important. It can help you gain a deeper understanding about the trend structure and momentum. See how the market is pushing into daily highs, pay attention to when the market is reversing into the daily lows, look for rejections, look for weakness and also strength around the daily high and low. Next, I use central pivot points, the daily and the weekly central pivot point. When you're searching for it on TradingView, it comes up under pivot point standard. This is the setting for the weekly pivot point. I turn off all my pivot point levels except for the central pivot point in P. You can choose either weekly or the daily if you're a short-term trader. This is the weekly central pivot point. In a trending market, what you will see is that first of all, the weekly pivot point is always higher than the previous one. This shows a healthy uptrend. The distance between the pivot points can also be of importance. When the pivot points are coming closer together, then it can indicate a change in sentiment and a loss of trend momentum. A common way to use the weekly central pivot point is for pullback and trend following trading. In an uptrend, when the pivot points are moving higher, you will look for moves that go back into the central pivot point and then look for rejections. Those can be used then for bullish trend following trading. And you can see this pattern time and time again in trending markets. Here we have a very great example of a market first starting in a bullish trending environment. The pivot points are moving higher and higher and higher. Here then first we can see that the pivot points are coming close together. The market is then failing to stay above the pivot points, and then the pivot points are rolling over and they are moving lower, indicating the downtrend. When this pattern changes and when the pivot points are moving higher again, this signals a bullish market. You can use it as a great trend filter as well. I love to use divergences on momentum indicators. For that you can use a MACD, a stochastic, and I like to use the RSI. In the RSI I use the default 14 period setting, and what you do is you look for deviations between the price action and the indicator. When the price action in a bullish trend is making higher highs as it does here, and then your RSI is making lower highs, this shows that the price action and the indicator are not agreeing. The indicator is picking up the weakness that you might not notice on the first glance when you just see that the market is moving higher. But there's a clear weakness here in the highs. The market is not able to push higher as quickly and as strongly as it used to. There's also a longer consolidation phase here, which shows further weakness. And then divergences in the right context can sometimes be used for great reversal trades to catch new trending markets into the opposite direction. Here we have it in the case of a downtrend. The market has been moving lower and the market keeps making lower lows. However, the RSI is picking up the weakness in the downtrend. The RSI is moving already higher. You can see the RSI is making higher lows, indicating the divergence and also foreshadowing a potential reversal to the bullish uptrending market. I'm a huge fan of supply and demand trading, and that's why on Pattern Alpha we also created a dedicated supply and demand indicator. The link to that is in the video description below, and it works for TradingView. After you've turned it on, the supply and demand indicator will show you supply and demand zones across all of your time frames. Here what you can see is that the market moved into a recent supply and demand area marked in red, found resistance here, gave you this very nice exhaustion pattern. Using an RSI you would have also gained here a divergence. The market rolls over and moves back into the next supply and demand zone to the downside. Supply and demand zones are quite similar to support and resistance, but they focus on other more momentum related concepts. They are a great addition to your overall trading if you are looking for strong areas of influence on your price charts. They are also really great for targets. Here we had a double top and the market broke out. Breakout traders would have benefited from knowing that there is a very strong supply and demand area here, because the market moved into the zone and the downtrend stopped here right away. So ideally, you would like to have your target at the supply and demand area so that you can exit your trade optimally. I love moving averages and especially the moving average channel. What I do is that I use two moving averages. You can use EMAs, but I use SMAs. I use the 30 period on both, and one is applied to source high and one is applied to source low. And this will give you this very nice channel. The channel is great for trend following trading. You look for a breakout out of a range, and then you can use the channel to trade your trend following trades with confidence. As long as the market is not able to break the channel and trading on the upside of the channel, typically this confirms a bullish trend. When the market rolls over, trades below the channel, this then confirms a trend change and can foreshadow a potentially downward facing trend. This is especially a great tool if you have problems staying in trades with confidence for an extended period of time. Having the moving average channel can really help you to stay in your trades with confidence and not exit them too early, because this is considered a trend following filter. I use Fibonacci target extensions a lot in my trading. You'll find Fibonacci's under the drawing tools, and then it's called Fib retracement in TradingView. Here are my settings. You can pause them, and those are the levels that I'm using in my own trading. I love using Fibonacci extensions for targets. What you do is you look for an ABC move. A is the starting point of a trend, B is the first end wave, C is then the end of the correction wave. In this case, it goes to the 50% Fibonacci retracement level. And then if you're looking for trend following targets, you typically go to the 161 or sometimes in strong trends to the 200 Fibonacci extensions. I made videos about the Fibonacci rhythm and the Fibonacci trend symmetry before on my YouTube channel. I also go further in this into my Trade-Academy. If you want to learn more about my mentoring, check the link in the video description below. There I also explain each of the tools that I mentioned in this video and many more in more detail, and provide actionable trading strategies in the Trade-Academy with mentoring from me. Here we have another great example of the Trade-Academy. We have an ABC move, A, B, C. The retracement in this case goes to 61.8, and then you can see the following trend following move goes to 161 first and then to 200. After 200 we see a little bit of a move further. However, afterwards it seems like the market is putting in a double top and you clearly want to be out. So looking at Fibonacci extensions for targets can really enhance your understanding of trends and help you plan a more objective trend following exit approach. And finally, I love Bollinger Bands. Bollinger Bands can be used in many different ways. I like to use it for reversal trades. And then what I do is that I open the Bollinger Band setting in TradingView, and under multi-time frame, I set the time frame for 4 hours if I trade the 1 hour or maybe the 30-minute time frame. This helps me to have the higher time frame Bollinger Bands, like in this case, we're on the 30-minute, but this is the Bollinger Bands from the 4 hour. And what I do is that I look for exhaustion. Here we have a strong uptrending market. The price tried to break outside of the Bollinger Bands, but it failed. We have a double top here with a fake out. The market rolled over. We had a break and retest pattern here. And then the market traded to the opposite side of the Bollinger Bands. So for range markets on a higher time frame, we can really nicely use the Bollinger Bands. However, Bollinger Bands can be used in many different ways. Here what we have is a Bollinger Band squeeze breakout. What we have first is that the Bollinger Bands are coming close together. You can see that the bands are very, very narrow and very close by. This happens when the price is in a tight range and not moving much. Then what you could be doing is look for a breakout out of the channel, and then as long as the market stays close to the outer Bollinger Bands or maybe even outside of the Bollinger Bands, this could be your trend following signal. So it can be similar to the moving average channel, but it uses different components because we also have the squeeze here that helps you identify a range market. Of course, there are many, many more trading tools that you can be using. However, I found those 7 the most helpful ones. They help you to understand the markets in many different ways. They all focus on different parts of trading, where it is trend following, reversal trading, exhaustion trading, or helping you to find key levels on your price charts. So using them together or just combining 2 or 3 of them can really enhance the way that you look at charts.